Right, we seem to have reached a stable number, so I'm going to go ahead while people are still coming in. Just a couple of things to say. Thank you all for joining us this evening. We know that your time is very precious to you, so we do appreciate you coming in to join us. A couple of housekeeping points. Please mute yourselves while Ashwin is presenting. We will have time for questions about 3/4 of the way through the webinar. So if you would like to then raise your hand or submit your question into the Q&A box or even the chat box, we will then get back to you on that. We do have quite a large number of attendees this evening, so please don't worry if we don't get to you. We will, if you put your question in the Q&A, we will get back to you tomorrow at some point. Right, so without further ado, I'm going to pass you over to Ashwin, who is the head of Farmer Wealth. And for those of you who may have joined our virtual conference last year, you'd be pleased to know that Ashwin's presentation to date has been the most viewed on our YouTube channel. So clearly the why we need to know your numbers is so important, and people are still referring to that. So over to you, Ashwin, and I'll leave it with you.
Wonderful. Ladies and gentlemen, thank you very much for joining me this evening. I really appreciate that. It's been a long day for you all. And can you move the mouse up again? And of course, we have a lot to get through today. So why don't we dive in? Let's dive straight in and talk about what it is we want to get into today. Please give me a second. I'm just going to get this. So why is it really important for us to know our numbers? It's really important because without knowing your numbers, how do we know exactly the track we're running on and which direction we're heading in? So what we're going to ensure this evening is that we share with you what are the important numbers that you must know. And once you know them, how you could utilize them to improve your returns. We'll be talking about retirement planning today. By knowing your numbers, you will understand which assets need to be in place at the right time that are accessible, generating the right levels of return in order for you to retire comfortably. And for many of us, it's really important that when we're gone, we leave our family and our spouse in a comfortable position. So that's really important when we're talking about knowing your numbers and retirement planning. When it comes to selling your business, how do we increase our returns when we sell our business? Many people will, obviously, you'll say, well, Ashwin, or my nickname is Ash, if we can get 10,000, 20,000, 50,000, 100,000 more, that's how we increase our return on selling our business. Now, that's not something I can assist you with. That's more, of course, your field. However, how about increasing the return when we sell our business by minimizing the tax, ensuring we get the maximum amount of cash? And this needs to be done correctly prior to sale. And finally, how do we protect our life's work? We do that by ensuring you've got the correct framework of wills and trusts and estate planning, and you'll have the certain knowledge that you've cut out the unnecessary taxes, leaving the maximum to our loved ones and the minimum to the Inland Revenue. But none of this will happen unless we take action. So when is the right time for us to take action? Maybe now is a good time for us to take action and to assist you with your unique situation. So what are you going to have by the end of today's presentation? You're going to have an easy way to ensure all the things we talk about happen for you. And we'll ensure that you get that opportunity to meet with me one-to-one. How might you feel at the end of this evening? That would be nice, wouldn't it? And to sleep like this means you know you've protected your loved ones. That's ultimately, for many of us, is to ensure that we get the benefit of our life's work, and when we are gone, our loved ones get the maximum benefit of our life's work. So, however, there is a problem, and that problem is the time you've put into developing your businesses and your career, and the effort with which you've developed your businesses and your career. And I've been advising clients for 30 years on the 1st of June this year, and 24 years specifically with pharmacists, independent pharmacists. And the business acumen those people bring to the table, I haven't met anybody who's not financially successful. But that financial success also comes with some burden. And let me share that with you. The latest figures that are published by the HMRC in their annual reporting suggested that in the tax year 2019, they had raised taxes and income to manage the country of 636 billion. However, the expenditure, and they call it managed expenditure, for the same tax year was 881 billion, which means there was a deficit of 240 billion. Ladies and gentlemen, tax year 1920, before COVID, in one tax year, we had a national deficit of 240 billion pounds. How about the year prior to that? There was a deficit of 223 billion, and even the year before that, 229 billion. Now, since then, the world has changed. Since, I suppose, February/March of next year, the world has changed. And what's changed is, here in the UK, we are being told by the Office of Budget Responsibility that COVID has cost, in the tax year we are in now, which is due to end in a few weeks' time, COVID has cost the government an additional 355 billion, with an estimate for next year of 234 billion. 589 billion pounds is what COVID is costing our government across these 2 years, let alone the figures we've previously spoken about. So, if you don't plan, none of us fail to plan. Sorry, none of us plan to fail. But if we fail to plan, this is what's going to happen. And the revenue are waiting to fill their buckets for those of us who don't get around to planning the best way we should be planning. So, when speaking with my independent pharmacy clients, what are their needs? Well, you all know the average age of the independent pharmacist is getting right towards retirement. And many of them are thinking about, when selling our business, how much will we get for our business? How much tax will we have to pay? And how much of those proceeds can we keep? So this is the importance about knowing your numbers, so we can get some accurate figures around that and do something beforehand, so we can reduce that have to pay tax, reduce it. Obviously, if you're planning to sell, it's likely you're planning to retire. Most people want to know, how much income can I have, inflation-proofed income, from my existing assets and savings? And that's not necessarily an easy thing for people to figure out. There is a lot of technology, a lot of thinking that goes in behind that, and I'm going to share some of that with you in a moment. And of course, having paid all your taxes during your lifetime, when we retire, we want to draw our income in the most tax-efficient manner. And as I said earlier, when we're no longer here, many of us will want to ensure our loved ones will continue to receive a sufficient income and remember us in a good light for having left them in a comfortable position. And of course, how do you protect your life's work? Well, what's going to happen to our assets when we die? How much tax will my family pay? Is it fair? And what can I do to minimize that tax? I'm going to circle back just for a second to pose that question one more time. Is it fair? Having been in the advice business for 30 years now and trained prior to that in the world of accountancy, I've had the opportunity to really reflect on that question. And I must tell you that most of the entrepreneurial clients that I work with, as well as for myself, I feel we pay a disproportionate amount of corporation tax, income tax, capital gains tax, and then finally at the end, the inheritance tax. Now, when I say a disproportional amount, let me just clarify for you what that means for me. For me, it means how much are we putting into the system because of how hard we've worked and the risks we took to create that. And then what do we get back out of the system? I feel it's a little unfair. So that being the case for me, if you feel that way, then you might find today's presentation really interesting. But when it comes to this topic, there are many variables, and everybody has different circumstances, a unique family circumstance, different number of children, married, not married, etc., etc. So when we work with our clients, we build our planning based on their specific needs. But today, what we'll find is likely there are three types of people in the audience. Number one, those of you who are here because you're fairly certain you've done it all and you just perhaps have a recheck. Wonderful. I'm really pleased that you're here today. Some of you are wondering, is what I've done correct? And have I utilized all the correct tax breaks? My experience is for many independent pharmacists, they are simply so busy, they don't get around to finishing everything. So that's not the case for everybody, but I do find that there is more people who are just really busy. And frankly, so am I. I'm pretty much the same version of you, but because I've learned that from you, I surround myself by people who get my stuff done. If you're too busy, that's what's going to happen when the revenue put their hand in our pocket and take unnecessary taxes. So when it comes to retirement, I suppose the question is, can I enjoy my retirement? Yes, you can, if you know your numbers. I often find that some of the people we work with, if they had an opportunity to know their numbers really well, they may have actually retired 5 or even 10 years ago because they recognize actually we truly have sufficient income and capital to have retired back then for the rest of our lives and do the things that we may want to do when we're gone for our children or perhaps along the way. But we've got to know our numbers. So how do we help you establish how do we help you establish your numbers? This is a complex field, ladies and gentlemen. So we take advantage of the best technology, which incorporates all of your affairs, including the taxes, etc., etc. We put it on a timeline. So we've just got a simple example here of a husband and wife and their individual circumstances. I won't go through every single line on it, but we've got a simple example here. And what you'll see is we've created analysis here, which takes their income and their expenditure, and we've understood what the taxes are on their income accurately, often better than themselves, but that's my job and I love that. I really do enjoy that. And we've then taken from them, at this moment in time, what is your expenditure over the next X period of time? How much are you saving? When should that saving stop, or when will it stop? When will the mortgage be paid? And when you retire, what do you truly want your life to look like? Not, ladies and gentlemen, how much can we have? More the case, truly, if you could take the shackles off it all and ask yourself, what would we really like after 40 years of work? What would we really like? So we went through this exercise with Atul and Jolpa here. Names have been changed for obvious reasons. Went through this exercise, and here we've got a little cash flow modeler of what they're telling us that they want. And here's their overall wishes. They want to retire 60, 65. They'd like an income of 80,000 net of tax. Fairly significant. It's because they really want to travel a lot. And they'd like that income for circa 20 years, after which they think we don't need to travel quite as much. We probably won't want to travel quite as much, and we can live on a reduced income for the balance of our lives. And of course, they want all of this inflation-proofed, really important. So with having done their detailed analysis, this is what we worked out. The current setup is actually going to run out at age 82. Based on blue sky thinking, based on having that truly take the shackles off, and what would I really, really love to have? What freedom would I love to have? And in order to put that right, we've created detailed analysis. And what our analysis led to was a simple move on this line for Atul and a simple move for this line for Jolpa means this is what their life's going to look like based on the assumptions we've used. So having detailed analysis will allow you to retire comfortably, but with certainty. Now, prior to that, we may be thinking about selling our businesses. And should we be thinking about doing that, one of the most vital things that we do is to ensure that we've structured our businesses correctly prior to sale. Why? When we come to retire, should we sell our businesses, the revenue recognizes only two types of business: a trading business and an investment business from a tax perspective. My wish for you, if you're selling your pharmacy, is that you pay the least amount of tax on retirement. And one of the major ways of doing that is to ensure your business is classified as a trading business, not an investment business. And for today, we won't get deep into that because, of course, if you know potentially I have got assets inside my limited company that have nothing to do with my pharmacy. They may be an ex-Barclays bank building that I've purchased, or it could be a number of other properties that I've purchased. Why? Because I've worked really hard, I've made some money, and I wanted to put my money to work. But inside your pharmacy business, it will cause you a problem when it comes to retirement relief, ultimately previously known as entrepreneur's relief, today known as business asset disposal. So if you could retire and pay only 10% tax on the sale minus purchase price, that's a wonderful place to be. But if you don't get this right, you'll pay 20% tax. So how do we protect our life's work? Well, it's vitally important that we make a will. Why should we make a will? It's really important to make a will so that when that worst situation happens, one of us pass away, then we don't leave our family in a legal mess at the worst time possible, at this very emotional time. But making a will is not enough. For the clients I work with, it's a really great idea for us to assist you to review all the tools that are available to reduce your inheritance tax liability. And actually, many estates can be pulled apart with divorces, bankruptcy, creditors, remarriage and divorce. That's called social impact. This is social impact stuff. So this may be for our spouses. If should I pass away, I have a lovely wife, and my mother was widowed very young. It's very sad, and she spent her life all by herself. So my wife and I have discussed that, and as a son, I think it's been very sad for my mom. So for me and my wife, I would be very happy if she met a new life partner and continued, etc., etc. I think it's a good thing in life to have companionship. But I want to make sure the assets are protected, because the next time round, maybe she didn't make quite as good a choice as she did the first time round. So how do we do that? The way we do that is to ensure that you've got a complete framework to protect all of your assets. So you'll notice here, we've broken down the assets in different categories. The first thing we're talking about is asset preservation, such as your main home. How do we ensure when the first person is gone that that asset is preserved for the widow or widower or partner and children later on, without it being pulled apart by anything else along the way? Also, many of us may want to assist perhaps family members by lifetime gifts. How do we ensure when we gift money, as an example, to our children to purchase their first home, second home, or whatever it may be? How do we ensure that that money is protected to stay in our bloodline? That the gift we made to our son or our daughter does not end up in a divorce court on somebody else's balance sheet. Next, for many of us, we'll have life assurance policies. The amount of times I come across life assurance policies that are not in trust. The only time a life insurance policy is going to pay out is if I die. I don't need to own that. I remove the ownership of it, put it into a trust today, which means I no longer own the asset, and that policy will hopefully pay inheritance tax-free. There's a few things we need to do to make sure it will pay inheritance tax-free. So that's what we want to do. Why should we want to own those policies in our own name? We can pay the premiums, but just put them in a protective wrapper. Pensions. Many old-style pensions are not actually inheritance tax-free. A modern pension scheme has the ability to be what I describe a family trust. Spend as much money as we can or need to from there, and when we pass, the balance of it passes inheritance tax-free to our families. So there's important things that we can do to ensure your existing pensions are protected correctly with today's legislation, and also that that money is protected against social impact, as we discussed earlier. And of course, as I alluded to earlier on, many of us will have worked really hard and added that business acumen. We've been careful with our money, and we managed to accrue other assets, other properties, other investments, etc., etc., our residual estate. So what can we do to protect that? So you can see here that we've thought about this very carefully and broken it down into all those areas. And our framework will allow you to protect all of those areas. I'd just like to show you one simple idea here today that will give you a flavor for which direction we can head in here. So, as you can see from this diagram, if there was client 1 and client 2 who owned a home and they had some savings, etc., etc., one of the really important things to do as we get older and as we come to doing this kind of planning is to not own our assets jointly. I say that again, not own our assets jointly. We can own a property together. My wife and I, we own our home together, but we don't own it jointly. By owning it together, nothing changes other than when I pass away, my half share of the house can fall into my family flexible trust. What does that do? What that does is it means my share of the house is not owned by my wife Deepa, it's owned by a trust in which the trust says she has lifetime tenancy. She can live there for as long as she wishes. The trust also says, should Deepa wish to sell the house, my half of the proceeds will go to the trust, her half will go to her, and when she buys a new house, the trust has to facilitate my half in order for her to buy if she needs to use some of my money. But my assets will be held here. Now, what's the benefit of all of this? The benefit of this, should Deepa go into a nursing home, then as you all know, the local council will ask us to use our own assets. But at least my half share of the house cannot be used for that. What happens if one of my spouse and or any of my children are attacked by creditors or bankruptcy? That asset is protected. What about once it's in the trust, will it help my children for future inheritance tax planning? Absolutely, and we'll talk about that in a moment. What if one of us was to get remarried and we didn't make as good a decision the second time round as we did the first time? Then of course that trust asset cannot be called up in a divorce court. And what about the residential nil rate band? Some of you may be aware that the revenue have got two inheritance tax-free bands. One is what they call the nil rate band, and another one it's to do with principal private residence. And as you've seen, there is massive deficit. And as we've heard, Rishi, very, very intelligent gentleman, how he's raising taxes. How is Rishi raising taxes? Can I just have the budget planner? I think it's just there. Rishi's raising taxes by, oh, here it is. Part of it is direct taxation. It's very clear to us how he will run, how he's raising taxes. Business taxes. He will be increasing corporation tax from 19% to 25%, depending on your profit levels, in 2023. So we're just around the corner. That increase alone, ladies and gentlemen, that's a 31% increase in corporation tax. How else is he raising taxes? He's raising taxes by freezing a number of allowances. When you freeze an allowance and the cost of living increases, it means we end up paying more tax. There's no doubt about that. Our personal income tax and the higher rate tax brackets, they're being frozen from this tax year for the next 5 years. The inheritance tax allowance is frozen. Your pension contribution allowance is frozen. The amount of pension you can actually save efficiently, that's frozen for the next 5 years. The amount of money you can pay into an ISA, no increase there. Junior ISAs, etc., against a backdrop, ladies and gentlemen, of minimum wage increasing, corporation tax increasing. This COVID-19, effectively last year, we entered a recession. So it has affected the economy and the cost of living has increased quite significantly. In fact, again, the Office of Budget Responsibility suggests that by 2023, the borrowing the government will be undertaking is 97% of our gross domestic product, of our GDP. It's really, really eye-watering, absolutely eye-watering. So Rishi's doing the job he's employed to do, and he is going to put his hands in our pockets. So we must ensure that we tighten up all these small areas that can make such a significant difference with the work with paying less taxes to the revenue legitimately and keeping more for ourselves and our families. So what are some of the things that we should be doing here? Well, as I say, if you have assets, you should equalize them. Your home, your savings. So if you've got £100,000 in a joint bank account, split them 50,000 each. If you have joint investments, consider trying to split those. You have to consider the taxes. If you have businesses, try and equalize the shareholding. Why? Because when you come to sell them, you'll claim what was formerly known as entrepreneur's relief, up to a maximum of £1 million each, though. So you need to have equalization of those assets. And of course, by putting the correct framework in of wills, trust, and estate planning, again, we're protecting against care fees, creditors' bankruptcy, further and generational inheritance tax, marriage after death issues, divorce, and ensuring we use the residential nil rate band at the time we pass away, in case in the future they withdraw that. There's always that possibility they could withdraw it. So if we don't utilize it at that time of death by documenting it within your affairs, and then later they remove it, it's gone. It can never be used. Right. So can I perhaps share with you how I've structured myself and my wife's wills and trust planning, because that might give you an idea of what does a real life situation look like. So can we just go straight to the whiteboard, please? All of us, we have our home. And if I had a regular jointly owned property and a regular will, on my death, it's likely that the whole property will pass to my spouse. There are dangers there, as we mentioned before. So what should we do, and what have we done? We've split the ownership of that property, even with, I have a mortgage, and the mortgage companies are not interested in this because it doesn't affect their ability to collateralize their loan against your home. We've cut the ownership in half. It's called severance of tenancy. And what does that mean? It means that should I die, my half share of the house will fall into my family trust. And the minute the my half share of that house falls into the family trust, it is protected against any creditors, debtors, remarriage and divorce. And equally, when that asset finally passes to the children, it is not part of their estate. That asset is not part of my children's estate. They have access to the money, which I'll talk to you about in a moment, but it's not part of their estate if they utilize the planning the way I've suggested. In addition to this, like many of you, I own my own business. None of us actually own a factory, but this is the old-fashioned business symbol. So again, in my case, we own our business. I must be honest, it's not exactly 50-50, it's 51-49. Not sure quite why. But should I die, my share of the business falls into a business trust. Now, this, ladies and gentlemen, is really, really important. Business trust. Right, let me explain something. This is so vitally important. In my case, and like many pharmacies, businesses have got significant value. You know, what we may have paid for our businesses 30, 40 years ago, and despite the fact goodwills have fallen, these are still significant figures, you know, often 750 to 1.5 million, depending on your pharmacy. And if you don't have the right framework, then what will happen to my share, your share of your business, is it will pass to the spouse based on a simple will. That does not make sense, because my share will fall into this business trust. And should Deepa wish to continue running the business, the trust will give her the power of voting rights, dividends, income, etc., etc. She can still have all of that. But should she wish to sell the business, let's say it was £1 million, she will end up with £500,000 in her personal bank account, but my £500,000 went in on my death as a trading business, shares, in here, inheritance tax free, and when they are cashed in, i.e. the business is sold, that trust will fill up with, as an example, £500,000 with no inheritance tax liability at that point and in the future, should she utilize the planning as I would recommend. What else would we have? Savings. What kind of savings? ISAs, bank accounts, share portfolio. Savings, investments such as properties. So again, if we have a regular will, what's it likely to say? To my spouse and then my children equally, often as a case. Again, in my will, no. Firstly, everything's split in half. The second thing is, should I pass away, that will fall into a family income in possession trust. My assets will fall in there at the time of my death, and once again, Deepa can still have the rental income, etc., etc. So if this is how it works to start with, what then happens later? So how does Deepa get access to the money? How does she get access to the money? So the way we structure our planning is that the trust will allow distribution in a number of ways. One way would be that she can have a direct distribution of whatever the lump sum figure is, or whatever the income annually, monthly, quarterly, however she wants it. She can have direct distribution. However, I think there's a smarter way of her accessing the money, and that would be via the trust can facilitate a loan to her and or loans. Not only to her, it can facilitate, we have 2 sons, it can facilitate it to our 2 children, our 2 boys. Now, what is the benefit of Deepa accessing our family money, or at least my share, via a loan? If when I pass away, she has my assets fall into a trust, various trusts, but then she has obviously all her half share of assets. And let's assume for a second, it's an additional £1 million of assets she has. As she spends her assets, that's fine, because then she's leaving less to our sons. However, she might find times where she needs a top up, or she wants to give some money to the children. And if she was to take a loan from my trust, on her passing, she has a debt against her estate. So when the boys speak to the solicitors or the probate people to settle her estate, she will have left X amount of asset, but the government will also be told, the Capital Taxes Office, who deal with inheritance tax planning, that my mother also had these loans to these trusts, and they have to come off her assets. Effectively, she has a smaller net asset on paper, which reduces the inheritance tax planning. So this is really important to structure things correctly. So not only can she have access to the assets, but they are protected from all the other things we mentioned prior to, and then it can offer this loan back facility, which is very honest and clever tax planning. What happens next? When the boys then will receive the balance of the assets, perhaps during her lifetime and or after her lifetime? Well, because my assets are in trust and then her assets fell into trust, of course, those assets are not in their estate. They can equally access loans, so they can still utilize the money to continue with their lives, whatever it may be, buy bigger homes or educate their children, etc., or their grandchildren maybe. and they can do that via loans. So again, they're creating a generational inheritance tax planning tool. At this moment, ladies and gentlemen, I'd like to just welcome if you've got any questions for me. Can you see if we can get the chat? In order for me to answer your questions, I'll need you just to type them in to the presentation, to the chat box, please. So let's see. Ashley, have we got any questions yet?
Yep, we've got quite a few coming through now. It says, does the trust grow as it ages?
Trust grow as it ages, okay.
The next one is, where is the best place to start a pension when I have not got one? And does the trust have to pay any tax on income generated within the tax?
Yes, brilliant. Excellent questions. Excellent questions. Right. Does the trust grow as it ages? Well, that's very straightforward. Whatever asset you put in that, so if you held a buy-to-let property as an example, when we're talking about capital growth, whatever the market capital growth is owned in our name and or in the trust is dictated by the market. Should I have a portfolio of shares and they fall into the trust and the trustees want to maintain those shares, obviously the market will dictate the growth of those. So yes, of course, assets can grow in the trust dependent on what those assets are. Where's the best place to start a pension? Great question. Well, I don't know how old you are, and when you say you have no pension at all, if you absolutely have no pension rights at all, the maximum you can pay into a pension in any tax year currently is 40,000 gross. But there are a number of things that's subject to. If your company is paying, the company can pay often 40,000 gross. If you're paying personally, you can only pay up to a maximum of 40,000 gross up to your income level. And that depends on the schedule of income, salaries, etc., etc. Certain classes of income do not qualify for making a pension contribution, but a pension contribution from a pharmacy for its shareholders and or directors almost exclusively qualifies, but we'd have to check that with you. For the individual who said, I haven't got one, please be certain that that is the case. So if you've been in an auto enrollment scheme, or you happen to have trained at Boots or Superdrug or etc., you have got a pension. Now, if that's the case, the revenue want to know if you are enrolled in a qualifying pension scheme, you can actually utilize this year's 40,000, go back 3 years, use 40,000 there, 40,000 here, and 40,000 here. It's actually possible to make a pension contribution of £160,000 in one go and claim the full corporation tax relief or partnership relief. That, you know, this is stuff that is personal to an individual and their circumstances, so we'd have to check everything to ensure that they can claim all these tax reliefs, etc. But it is possible to make large pension contributions. That is per individual. So if you are a two-partner business, whether that be you and another business partner, or a couple, in my case it's a couple, then we could potentially pay £320,000 into a pension scheme in 1 year. Do the trust pay any tax on income they generate? Absolutely. The current setup for a trust is it will pay tax at the highest personal rate, which is 45%. However, take a step back to what did I say? The trust framework and the planning we set up allows the trustees to appoint the income to an individual. When you keep the asset in the trust, but you appoint the income to an individual, the individual will pay tax at their rate. So if they're a basic rate taxpayer, they'll pay it at the basic rate, 20%. If they are a higher rate taxpayer, 40%. And of course, an additional rate taxpayer is 45. So the trust can actually appoint the income out, and you can do some tax management that way. What are the tax implications for a trust? That's a really broad question. And I don't know how to narrow down on that. But the thing I must tell you is that trusts do require some management. And they require that management once a settlement has been made into it. So, i.e., if during your lifetime you wanted to put something into a trust, a gift maybe of £100,000, which could then be loaned to proportion or entirely to one of your children or all of your children, whoever you wish, then that asset clearly will require some management. And the management, it's currently, there's a consultation going on. We're fairly certain that the consultation will come out that once an asset is in a trust, once a trust has an asset, it will require an income tax return every year. So I wouldn't worry about that too much, because there's plenty of people who provide those services and provide them cost effectively. But we have to look at the bigger picture of what are we saving by having the trust in place, and what are we protecting by having the trust in place. And this isn't set in stone right now, but I'm fairly certain it's going to happen, and it's obviously right for me to forewarn you about that now. Is it better to have a trust offshore? Right. I rarely use offshore planning for clients, because most of my clients live onshore and they have no clear picture that they're absolutely going to live offshore and be domiciled in a different tax haven. So really, I would suggest that if somebody is considering that, then we can talk to them for their individual circumstances. I think for the majority of people on today's call, it's unlikely that they'll be moving offshore. Wonderful. Loans made to family members from trusts, do they have to pay interest on those loans? That's a great question. Only if the trustee requests so. So in the event Deepa wanted to draw 20,000, 50,000 per annum and or a lump sum, then she can discuss with the trustees, one of which is herself, by the way, whether the trust wants to charge an interest. And that will be between the trustees and the person borrowing the money. In my case, at this moment in time, neither of us has died, so we don't know yet. But if we want to try and increase the debt on Deepa's estate, then of course there should be interest payable to the trust. But then there's a tax burden. But if she wants to keep her life simple by saying, I don't want to see money flowing in and back out to the trust and it paying 45%, actually, I think I'll just keep it simple. I'll borrow the money and there'll be no interest. So there is no obligation that interest must be charged, but it can be charged. Right, another fantastic question. Can children borrow money from a trust for an indefinite period of time and perhaps never pay it back? Once again, the trusts are governed by or ran by the trustees. That arrangement between the trustee and the beneficiary is for them to figure out, should we have this amount of money loaned for a period of time? Can we have it open-ended? And if it is open-ended and somebody passes away, what then? Well, that's the scenario I'm discussing here, that actually there's a possibility in my scenario that should Deepa borrow money from my trust, it's likely she'll do that indefinitely. That's what I believe she would do. Certainly if she passed away, there's a good chance that I'd borrow money and it'd be indefinitely. Right, over what period do you repay the trust? And the next question is exactly the same. So once again, ladies and gentlemen, we've just covered that off. However, I must say one thing, that when the trust comes to life, comes to life, meaning when you've put some money into it, that's called a settlement. That's when it comes to life. From that day, that trust is actually valid for 125 years. So I will say to you that trusts have to end in 125 years, and they have to fold, and the money has to be paid to the beneficiaries. Now, ladies and gentlemen, 125 years is a long time. That's 2-3 generations' time. So I'm not going to worry too much about what's going to happen at the end of 125 years if I can, within my lifetime and my thought process, think about my wife, my children, in the future, my grandchildren. And I think if I can think along those lines and all the hard work I've done protected for 125 years, it's probably good enough for me. That's good enough for me. So I think we've dealt with a number of questions.
Ashwin, sorry, there's just one on the Q&A,
Yeah.
and it says, what are the rules to how these trusts are set up, and how many trusts can you have?
Wonderful, great. The rules of how the trusts are set up are governed by HMRC, clearly, because we want to ensure whatever is set up for you is done within their framework. So ultimately, a trust is a legal document. It's as simple as that. So as long as that legal document is written up correctly, then you have a valid trust. So what does it require for a trust to be set up? Well, it requires a legal advisor to put that in place for you. Now, I only have 2 business interests. I help people with their wealth management and manage their taxes in my financial services business. And the secondary business I have is an estate planning business that will assist people to create the correct framework of wills and trusts and estate planning. So we can do that for you by understanding what your complete affairs are and setting up the appropriate trust. How many trusts can you have? Actually, there is no limit to how many trusts you can have. And most importantly, we just need to ensure we have the right number of trusts for your framework, for your setup, what's right for you. So as you can see in my circumstance, there is 3 types of trusts here. Yeah, I actually have another trust, which is for pensions. I have a modern style pension. Both Deepa and I have modern style pensions. And on passing, if I was to pass away, that pension has the ability, because I've written it in modern style and I've written some technical notes for the trustees to refer to. The pension company are the trustees often. And those technical notes will state that in the event I pass away, please pass my share of the pension to my wife. Although, if she wishes to forego some of her right to bypass that money to my sons, she can do so. I've made that clear to the trustees. So if I was to die and I left £500,000 in a pension scheme, she could have it all added into her bank account, which is foolish. She will not do that, I'm quite sure. She will either have the money sent to her pension because it stays in a pension wrapper, a family trust. Alternatively, she can say, I'd like to give up 50% of that right in favor of my 2 sons equally. So she'll get 250 and the boys will get 125 each. Once again, likely to be in a pension. So it's in that family trust. Now, what if in life, not all things are equal all the time? So what if Deepa came to a place where she said, I don't need his pension income. He was the big spender, which is true. So she doesn't need my pension income. And she's quite happy that the boys do get it. But one of our sons is perhaps in a difficult place, either personally or in a relationship or whatever it may be. And so she feels, I want to reserve that money for him, but I don't want him to have access to it. And that's why we have a pension trust. So she can have whatever she wants and or nothing, and whatever proportion she wants to give to one son, it can go there into a pension directly. And if the other one, she wants to retain that benefit for him for a later time, she can send it to a pension trust. Obviously, I mentioned earlier on, life insurances really should all be in trust. Why? I have to die for that life insurance to pay out. What is the point of that money going into Deepa's Lloyd's bank account? And particularly as she's frugal, she's careful, it's likely she'll leave a sizable estate for my children because I have a lot of life insurance. So obviously they're going to pay inheritance tax with any money in the bank and or any investments she makes with all of that. So rather than that, if the money went into a life insurance trust and that piece of paper, that legal piece of paper, was filed at a bank after I die, you have to open a bank account, a trustee bank account. That's where the insurance company will pay the money and she can utilize loans. So the amount of trust you have is as many as is appropriate for you. The purposes of those trusts, we would discuss what is the purpose of those trusts, and we could bespoke that planning for you. And we come up with the right framework for your circumstances. And we tell you all the advantages of the framework, as well as any disadvantages in case there are any. You should be made aware of that. So we'll absolutely make sure you're aware of that, that's clear to you, so you've made an informed decision. Yeah, can we move on, please? So, ladies and gentlemen, as time is marching on, yes, let's look at, Ashley, can you tell us that we're back on the slides now?
Yes, you are.
We are, wonderful.
Yep.
Next one, please, Tim. A summary of quick winning strategies. What are the important things from our conversation today that we should take away? First thing, all life insurance policies should be placed in trust where possible. Review all your pensions and investments for excess management charges. Is the risk that those investments taking appropriate for your circumstances? And are you getting the right level of return? I cannot express enough to you, ladies and gentlemen, this is so vitally important. If your investments are paying excess charges, you're just paying fund managers and insurance companies more money to run your affairs. And that is a very simple calculation, that if it costs X here, but it could cost X minus here, that is a direct saving. Fund performance is not something we can guarantee, but you should review your affairs regularly to ensure the investments you're in are within the risk tolerance that's appropriate for you and your family, and you get a suitable return for that risk tolerance. Check that all of your pensions are inheritance tax-free. Make sure that if they're inheritance tax-free, you have set up an appropriate instruction to the trustees that the money should pass to this person, and they have the option to send it to a trust for the right reasons. What about those companies that have excess cash? What should you be doing in the run-up to now retirement, and or even if it's before retirement? You really should be thinking very carefully about this. So think about boosting your pension funds. Why? Because you get full corporation tax relief if we pay the appropriate pension, appropriate contribution to a pension. That's the first thing. Comes off the company balance sheet, and it reduces the taxable profits. We pay less corporation tax. And of course, once it's in the pension, it grows tax efficiently. There is no personal tax to pay on the growth in the pension fund. And that is a family trust. Remember, there's no inheritance tax on that. Of course, when you come to retirement, you'll get a proportion of that completely tax-free, and the balance is a taxable income. But we can work out how can we pay the least amount of tax in that environment. The other thing that's important to be aware of is that if you have too much cash on balance sheet, when you come to retirement, you may not be able to access what was formerly known as the entrepreneur's relief, and now the business asset disposal. And therefore, instead of paying 10% tax on sale of your business, you may pay 20% tax. And ladies and gentlemen, this is really important. That tax bill will only be calculated after you've sold your business. You cannot get Inland Revenue prior approval. It happens after you've sold your business and it's reported on your personal income tax return. So this is vitally important. These little things here that we deal with at the right time, in the right way, so that later on, when it's too late to reverse that activity and do something, it's too late to do it. Really important. So next, down. Review your wills. If only for one reason, at least make sure they reflect today's wishes. Ladies and gentlemen, my father died without making a will. He left my mum in a comfortable position. I will tell you that. However, he left her in a mess because he had lots of investments all over the place and there was no clear instructions. And therefore, to settle the estate, it's significantly more expensive in legal fees if you don't even have a will. And then, of course, it's devastating if you do have a will and it doesn't even reflect today's wishes. So if for no other reason, at least make sure you've got a will to make sure there's not unnecessary legal fees paid, and at least your assets do go to the right people at the right time. Of course, it would be very useful to consider when setting up a will that you consider the framework, and maybe your will points to an appropriate framework of trust. Why? To ensure that we pay the least amount of taxes to the revenue and the maximum amount of our life's work goes to our loved ones. Remember, how are you going to retire comfortably, but with absolute confidence? How will you do that? This is complex. Again, like I've said earlier, pharmacists have worked very hard, business acumen, and they have, in honesty, complex affairs. They have complex affairs. Salary, dividend, rental income, capital gains tax issues from a investment portfolio, etc., etc. They're complex affairs. So working with somebody like me who loves that detail, I actually thrive on that detail of complexity. I love working that out with somebody and seeing how can we move the pieces of the jigsaw puzzle around so that we pay the least amount of taxes legitimately, which that in itself increases our returns. So lifetime cash flow statement and modeling and annual regular reviews is really important. That's the best way that we can achieve this. And know the difference between a life assurance agent, a financial advisor, and a financial planner. I rarely meet pharmacists who haven't already either met one of these three people or all three people along their journey of life and or engage the services of one or more at the moment. I rarely meet pharmacists who haven't already got an existing advisor, but we need to be aware, what do those people do for us? The life assurance agent, often a life assurance agent in today's world, they'll deal with mortgages and then the life insurance attached to that. A financial advisor will look at the different product areas, such as pensions, ISAs, general investments account, portfolio of shares, and they'll help you balance getting your money into the right pots. A financial planner will say, I'll make sure you've got the life insurance. I'll make sure your money goes into the right pots. But now I'm going to put all of that into a framework where you understand where is the money going to come from when? What is a reasonable rate of return for us to assume? Let's look at a scenario where there is a stock market adjustment in every period of time. You know, this is what they call this a Monte Carlo scenario. So we're looking at all these different scenarios, and then you can make great informed decisions. I think it's wonderful when people have worked for a long period of time and they get to retirement, and instead of saying, how much can I spend? They say, we planned for how much we wanted to spend, and our assets have been managed correctly, that we have certainty we're going to have a comfortable time in retirement. So, what's our 5-step guide? Our 5-step guide is, if after today's presentation you feel you'd like to progress with matters, then book a discovery meeting with us. How do you do that? Earlier in the day, my office sent you an email reminding you about today's presentation, and we enclosed a number of documents. One was our brochure about the company, what we do, who we do it for. Another one was just a little CV on the company, but more importantly, myself, so you get a feeling for who I am and my background. We have a document that talks about our client guarantee. What happens when we meet? What will you expect from the meeting, and how will we communicate the recommendations to you? And what kind of advisor are we? Well, I can tell you now, we are a truly independent advisor. We act in the interests of our clients, not in the interests of other financial institutions. We're completely independent. And also, what we expect from you, your commitment to us as well, and our commitment to you. How will we build a relationship for decades to come and ensure we keep you on track? So if you'd like to move to a discovery meeting, you'd like to inquire further about how we might work together, then there's the final, I think it's number 5 document, and it's called Your Information and Response Sheet. Please complete your name, occupation, organization name, and address, whether that be home or work, a contact number, an email address. If you'd like to give us both home and work, there's a secondary set of details you can give us. And then on the back, I'd be really grateful if you could rate today's seminar in terms of content and how did I deliver. If you like today's presentation, it's because people before you have told me how I can improve. If you didn't like it, please tell me so I can improve. And then, of course, there's boxes here for you to share what are your main areas of interest. Give us, if you'd like a meeting, tell us, and tell us exactly the best days and times for us to phone you. Please remember, Jo is a mum, so she works normal office hours, Monday to Friday. So please allow her to contact you during those normal office hours. Jo is my client relationship executive, so she will assist for the 2 of us to meet. And if you have something outside of these boxes here and you think, I've got my 3 main priorities, let us know what they are. And return that via either email to us, you can fax it to us, or of course you can send it into the NPA, who will forward it on to us. And of course, if you happen to have joined the call today and for some reason you didn't get this because the email we've been given was not maybe working or incorrect in some way, and or you joined after we got the last set of contact details, then please once again phone the office. We'll send those details out to you, and or contact the NPA. They will have all this stuff here. So that's how we would book a meeting. And in that meeting, what we want to do is address your needs and fears. What is it that you want to protect? What are your fears and concerns? What do we need to deal with first to eliminate your fears and concerns and help you towards your goals and objectives? By doing so, you'll gain confidence, particularly if we write a bespoke report for your individual circumstances that deals with what it is that you want dealt with. When we deliver that report to you and we go through that with you carefully and explain what actions need to be taken in order to remove your worries and concerns, to get you on track for achieving your goals and objectives, that's when we achieve freedom, because we know we've got peace of mind that things are being dealt with and then kept on top of regularly. So, ladies and gentlemen, we call this system our wealth management system. And as I've said earlier, this is the flow of it. Let's just show you. It starts with the discovery process. that is by way of us. After today's presentation, we will send you a 4-page document. It's called a lifetime focuser document. It allows you to get out of your mind three pages of hard facts: name, address, income, asset values, etc., things of that nature. The 4th page is the one I'm really interested in. Tell me about where you are with your wills and trusts. Tell me about what it is that you want us to focus on in your time with us together at that first meeting. And then finally, tell me what is it that we need to do for you to be happy with our work at the end of the first 12 months. So if that document's completed, preferably before the meeting, then during the meeting, I will have had that beforehand to review that and prepare for the meeting. So in that 1 hour, you get to figure out, do I like this individual sufficiently to ask them to write a report with me? Likability is important. If we're going to work together for 10 years, 20 years, you want to know you're going to enjoy that relationship. Secondly, do they have the skill set? And the only way I can demonstrate that is if I know what your affairs are in advance and an idea of what we need to talk about. So then during that 1 hour, I can share with you what areas we need to focus on, to change, to actions to take in order to achieve your objectives and your goals. And of course, if at the end of that meeting you say, this sounds great, now go away and put it in writing to me, that's when we'll write the wealth management plan. And the wealth management plan will be focused around what is important to you. So it could be estate planning, it could be developing your wealth, it could be protection of your wealth, or any combination of that, or something else. Once we've compiled that and we've delivered it to you, we'll have a planning meeting. So we can go through that and talk to you about how do we now practically implement these things. Clearly, there's the implementation process. And once we've implemented this planning, we want to make sure that you continue to stay on track by regular reviews. My practice does not seek transactional relationship. We do a little something and then you won't see us for 2 years, 3 years, 5 years. We're not seeking those kinds. We're looking for what we call lifetime relationships, where we add value to you by ensuring we keep you updated with your affairs, understand your changing circumstances, or not as the case may be, understand what effects the outside world has had on your affairs, economic, macro, geopolitical, taxation, etc., etc. All these things are important to be kept together. So what happens next then? Ladies and gentlemen, we're drawing to a close shortly. And once, if you would like to meet with us, please send these documents in and you'll be contacted lightly by Joanna Redding, but also Joanne Cook, my practice manager. She may also contact you if the hours are slightly different, ever so slightly different. And what have we given you today? So what have we given you today, ladies and gentlemen? The subject of today's talk was, how do we protect our life's work and increase the rate of return? So we've talked about having the right framework of wills, trusts, and estate planning. By doing so, we cut out the unnecessary taxes. Simply by not having the right documentation, more taxes often get paid. By having the right documentation, we pay the least amount of taxes, leaving more to our loved ones. Secondly, rate of return. How do we increase that? There's 3 ways to increase that. Number 1 is ensure whatever investments we have are paying the least amount of charges. Number 2, if we pay less in taxes, that increases our rate of return. And number 3, ensure that our portfolios are set up in a manner that we understand and we have made an appropriate decision about the level of risk we want to take, and we look at what is a sensible rate of return for us to try and achieve for you. Past performance is no guide to the future, you know that. But if you can see a system and a process, it helps you tremendously to plan for the future. So with that said, ladies and gentlemen, all that's left for me to say is thank you so much for your time today. God bless you all. Thank you for everything you're doing for the nation. We live in very difficult times, and it's people like you who put yourself at the front of this very difficult situation on a daily basis to help people like me. So thank you very much for doing so. Ashley and the NPA team, I'm very grateful for the opportunity to speak with your members today, and I look forward to seeing how I can assist those who have attended today. And I believe you're recording this, Ashley, and that will be made available also to people a little later. Is that correct?
That's right, yes.
Wonderful.
So just to mention that this recording will be online next week. I will send out the link. And again, if you have any questions that you would like to send to Ashwin, you're not sure where to send them, then please do just use the events@npa.co.uk and we'll pass those on.
Wonderful.
Great. Thank you very much for attending.
Thank you.
Take care. Goodbye.
Bye.